Remember when I told you this about Bumble? I kind of want to do Bumble. It seems like a more interesting opportunity, especially with a company with such a small market cap. And then right after that, I said this. The deal is, like, if it's going to go down, it's going to go down big, okay? And I'll just be wrong, and I'll probably be rolling like crazy to avoid assignment. If it doesn't go down, it's, if it's not going to be super bearish, if it's not going to break this level of support, then there's not much further it's going to go down at all. So I'd rather just get in, because either way, I'll be eating my words here in a minute if it breaks through this level of support. Well, you'll never guess what Bumble is doing right now. It's falling off a damn cliff. Okay, leave it to your boy to do the perfect analysis to a T, and then do the exact opposite of what the analysis was telling him. Okay, so we need to discuss how I like to handle the wheel strategy when my cash secured put is starting to get close to being in the money. Because the strike of my put is 55. The current stock price on Bumble is $55.18. So we need to talk about how I manage that strategy. But first, I got to plug all my shit. As always, if you want to follow all my trades, you can follow me on Iris, the mobile app. The link is in the description below. Please use the link and not just go off to the App Store because I'm affiliated with them. Also, you can find a link to the app called Options Profit Calculator, where you can calculate your profit and loss given certain stock prices across time. So it makes it's a good tool to choose price targets and figure out how much you could potentially make or lose. And lastly, there's a bunch of free stocks down there, primarily Webull. If you deposit $100, you can get 2 free stocks valued up to $1,400. And with all of that said, let's go ahead and dive in and catch you up on the stuff I've been doing while you weren't looking. Okay, so we'll talk about how to handle the wheel strategy first, but I want to talk about a few other things I did while you were away. So here we're looking at all my positions. AMD and Activision are the ones I want you to bring your attention to. Initially, these had an expiration of January 2022. Now they have an expiration of June 2022. The reason for this is because January is 9 months away. Okay, if I have a January expiration and I hold these options for any amount of time, I can't hold them longer than January. They expire in January. So I have to sell before then, right? Or exercise. And if I do that and I make money, I'm going to be paying taxes on those trades, and they'll be taxed as ordinary income, which is going to be much higher than long-term capital gains tax. If I hold these options for a year and a day or longer and sell for a profit, they'll be taxed as long-term capital gains, which is a lower tax rate. So that was my bad. I opened these leaps with too short of an expiration. I should always be opening them with a year or more so that I can anticipate potentially holding them for a year or longer to have preferable tax treatment. So that was my mistake. So I rolled these options out in expiration. And now that I've said roll, let's discuss what that means for those of you who aren't familiar, because that will come into play a lot when it comes to the wheel strategy. Rolling an option is just closing your current option that you have and simultaneously opening a new options position with the same underlying out in the future. It can be a different expiration and a different strike. It's just on the same underlying, and you're closing one option and opening another one simultaneously. So in this case, I sold to close the leaps that expired in January and simultaneously bought to open new calls out in next June. So I rolled my position out in expiration. So you're rolling out. With my AMD call, I actually raised it in strike by a little bit because the break even wasn't that bad, and it would free up a little bit of extra cash. It'll be a little bit cheaper than my current option. So I rolled out in expiration. I sold to close my current AMD option and bought to open a new one simultaneously out in June and raised the strike a little bit higher. So in this case, I rolled out and up. Out in expiration and up in strike. And by doing so, while I gave myself a lot of extra time, I gave myself preferential tax treatment if things go well, fingers crossed, and I made it cheaper. Okay, I rolled it up in strike, so it has less intrinsic value, and the increase in extrinsic value of that option was not more than the decrease in intrinsic value, so I actually freed up some extra money, and I threw it into Chegg, I think. I forgot to mention, if you guys haven't seen any of the previous videos of this series, link to the first one's up in the corner. Okay, and things are not going super great right now. All right, our profit loss year to date is minus $400, which isn't really that bad overall. It hasn't been that long. Has it been a week? It's been about a week. Okay, so, I'm always playing things to the long term. That's the point of my trades. It's to be longer term. Okay, I don't give a shit. There, I said it. Gosh dang it. I don't give a shit what's happening right now. I just care that stocks go up over the long term. Okay, with my shares, if things go down, I average down. With my leaps, if things go down, I buy new leaps. With my wheel, if things go down, I get a sign, I start selling covered calls. Okay, I got a plan for everything. No matter what happens, I know exactly what to do. When you're swing trading and you're doing day trading and all that shit, it's so cancerous. Your brain is constantly frying because you're constantly second guessing yourself super hard, and every decision determines whether you make or lose money. It's all happening right now, and everything's very realized immediately. Hate it. I hate that stuff. With this, it's like a simple formula. I know what to do. I can follow it. I'm never at a loss. So yeah, we're not making money, all right, yet. We're going to be making money. Don't worry. And now that I've caught you up on what I did with those leaps, let's go ahead and talk about what's going on with my Bumble put. So as I said before, I read this pattern correctly. I just didn't want to do it on Snap, and I kind of had a hunch that it might break up, but of course it broke down because it is a bearish pattern, and I'm just eating my words now. So now we talk about how to handle this position when things go against us, which is probably preferable, because if things go in our favor, there's not a lot of interesting stuff that can happen. You don't get to see how to handle positions that go against you, which is probably the most important thing you want to learn out of this. So it's diving off a cliff, right? We're hitting around $55.23 per share. The strike of our put is 55. So what should we do? If our put gets in the money, if the stock price drops below 55, what should we do? Should we close the put and open a new one out in the future? Well, at some point, if our put option does get in the money and it stays in the money, we should definitely do that. We should roll our put option. What we should do is buy to close our current put and sell to open a new one with a further expiration and a lower strike for credit. What that means is you buy the current put you own for a certain amount of money. You pay to close that put, okay, because you sold to open it. You received a credit when you first opened it. Now you have to pay money to close it. And simultaneously, we will sell to open a new put with a later expiration and a lower strike, so it's further out of the money, it won't get assigned. And we'll sell that one for more money than we paid to close this one for. So overall, we're going to receive more money than we paid. We get a net credit. We have more money coming in the door. If we can't roll for a credit, if I can't buy to close my current put and sell to open a new one for a credit, I would probably just prefer to get assigned. Okay? You can even roll it down and strike, like out in expiration and down and strike, and not get it out of the money. That's entirely possible, and that's still good, because if you get assigned, you'll be assigned at a lower share price. So it'll take up less buying power, and you're just buying the stock for a cheaper price, which is obviously great. If you don't know that, God help you. But the question is, when do we roll? Do we roll as soon as we think it could potentially get in the money? Do we roll as soon as it gets in the money? Do we roll when our balls just feel right? When do we roll? With puts, it's actually a little bit nicer, because the odds of getting assigned as soon as your put gets in the money, very slim. Very slim. Why is this? Well, why do people exercise options? There's a few reasons. For puts, there's really only two, in my opinion, that come to mind. One, the option is very illiquid. It's hard to enter or exit the trade. Maybe there aren't market makers there, or they have a very wide bid-ask spread, and it might actually just be cheaper to exercise. Most of the time, you don't want to exercise because you give up extrinsic value, right? If I have a put whose strike is 55 and the current stock price is 50, this put is in the money, right? How much intrinsic value does this option have? Well, if you sold 100 shares at the strike and bought to close 100 shares at the current stock price, you would extract $500 of value. So this option has 5 points of intrinsic value. It will also have some extrinsic value, and that could be something like 30 cents in premium. That is extrinsic value. This extrinsic value is given to the option based on time and implied volatility, because there's more time and volatility ahead of this option. There's time and volatility that could cause the option to get deeper in the money. This option could be more valuable in the future, and there's some value attributed to this option ahead of time because it potentially could get more in the money. So the total value of this option is $5.30. Well, what happens if you decide to exercise this option because it's in the money? Well, you're going to sell 100 shares at $55. You're going to buy 100 shares, buy to close, at $50 per share. So you're going to extract $500 through exercising this option, which is the exact same amount as intrinsic value. And that's no coincidence, because what you could extract through exercising an option has to be built into the option's premium. If the option is a ticket to $100, this ticket better be at least worth $100, otherwise you're getting free money out of it. So the value you can extract through exercising is built into the option. It's intrinsic value. But this is all we get out when you exercise. So we give up extrinsic value. We threw away $30. This went bye-bye. So why do people want to exercise options ever? Well, with puts, like I just said, is if the option is super illiquid, maybe you can't sell it, or if you could sell it, it's going to be at a ridiculous price. Well, then you would exercise. You just exercise the option. You probably extract more money or more value that way than selling at a ridiculous price. Another reason someone might do it is because they're stupid. There are people out there that exercise options because they just hear the word exercise when they're learning about options, and so they think they should do it. And so that's another reason. People are just dumb. Maybe even a third reason is people fat finger. Click the wrong button. Another reason is if you hit expiration. At expiration day, there is no extrinsic value left. There is no time. There's no time for volatility to affect whether or not the option is going to get deeper in the money in the future. So because of this, there's no extrinsic value. There's only intrinsic value left. And if you hit expiration and you're in the money, your brokerage is actually going to exercise that option for you to prevent it from expiring worthless. Okay, so for puts, those are really the only reasons, okay? Even with spreads, if you get assigned a spread, a credit put spread, you should just should close your stock position and then just sell your option. You wouldn't exercise it unless it's at expiration. So 3 reasons. 1, the option is very, very illiquid. 2, the person's an idiot or fat fingers. And 3, it's at expiration. There's no extrinsic value anyway, so you might as well exercise the put option to collect intrinsic value and prevent it from expiring worthless. Okay, so let's evaluate that from our perspective. We have a short put. Okay, here's our wheel. Here's our Bumble put. Let's unfurl it. It's a 55 strike put. Bumble is currently trading at $55.42, so it's not quite in the money, but it's getting close. What happens if our put option gets in the money? Will someone exercise it? Will our counterparty exercise it? Will we get assigned? Will we have to buy 100 shares at the strike as soon as it gets in the money? No, probably not, because this option, number 1, is not illiquid. Here's our option over here on the right. You can see puts at the top, so we're looking at the puts, the put chain. And you can see the option has 30 cents in the bid ask. You can see the open interest is over 1,000 and the volume today alone is 79. So this option is not illiquid in the slightest. Okay, so someone probably would not exercise for it being illiquid. Would they exercise because they're stupid? Potentially, but generally pretty unlikely that you're going to get assigned just because someone's stupid. So we're not going to worry about that so much. And then the last reason is, are we up against expiration? Is closing bell coming up? Is someone wanting to exercise to prevent this option from expiring worthless? No, because we have like a month until expiration. So what does that tell us? Well, it tells us we don't have to roll this option quite yet. Even if our option gets in the money right now, it's not something we have to immediately roll. We can give the stock some time and see if it's gonna bounce and start rising up and then push our option out of the money. That'd be preferable. Now, if it starts getting somewhat deep in the money, we may start getting concerned because it can be kind of hard to roll back out of the money once you get too far in the money. So we don't want this option to start getting super deep in the money, but if it's hovering around at the money, we're just getting in the money, there's no rush. We can let the stock play out and see if it's going to bounce and push our option back out of the money again. Now, it is totally possible to get assigned before expiration. The odds of you getting assigned increase the deeper in the money your option is and the closer to expiration you are. The reason for this is because the deeper in the money your option is, the less extrinsic value your option is going to have. If we go to our trade tab again, go to all products, look what happens when we get deeper in the money. We're going to go over to extrinsic value. As we get in the money and deeper in the money, extrinsic value shrinks. So if this option is super, super deep in the money, someone might decide, well, I'm just going to exercise this option, eat the 2 cents of premium, and just hold the stock position. Because there's only 2 cents in premium, or let's say for this option that we're looking at right here, it has 6 cents in extrinsic value, but the bid ask is, fairly wide. It's like 30 cents wide. Well, it actually might be cheaper to exercise this option than to sell it because you might have to give up a little bit in the bid ask. This is especially true if the bid ask is a little wider than this one. If there's only 6 cents of extrinsic value, then even a slight amount of illiquidity is going to be an issue. It's not going to be worth selling, so you just exercise, right? If I had 1 cent in extrinsic value for a put option and the bid ask is a 1 point wide, so $100, I would rather exercise because I give up $1 through exercising while trying to find someone to meet me in the bid ask. I might give up $10, $20, $30. So when it's deep in the money, it's going to have a small extrinsic value. That means that even if the bid ask is kind of wide, someone might be more inclined to just exercise. Also, the closer to expiration you are, the less extrinsic value your option is going to have. So same idea applies. Your counterparty will be more inclined to exercise because any distance between the bid and the ask prices is going to seem cavernous. It's going to seem like the Grand Canyon, and they're going to decide to exercise and give up less money that way. So right now, are we worried about assignment? No. If we start getting too deep in the money, if it really looks like things are starting to bottom out or like tank, then we should probably roll because it'll start becoming difficult to roll out of the money. And that's fine too, okay? So like if the stock drops, our option gets in the money and it drops really hard overnight, 15, 20%. Well, what are we going to do? We're going to buy to close our option. We're going to sell to open a new put option. Out in the future and lower in strike, we may not be able to push it out of the money. So we will still be potentially facing assignment. But the good thing is, 1, we're not going to get assigned immediately. 2, if we do get assigned, we're going to be assigned at a lower stock price. So that's good. We're going to be buying the stock at a cheaper price. And 3, since we pushed it out in expiration, we've given ourselves more time for the stock to bounce and potentially push our put out of the money. Okay, so all that said, we're not worrying about it quite yet. Okay, well, I'll keep my eye on it. If it starts getting deeper and deeper in the money, maybe I'll start rolling it out. But even if we do get assigned, it's not a big deal because that's part of the wheel strategy. That's part of it. Is assignment, it's going to happen. Okay, well, you might be wondering, Adam, how do you roll your position, especially if you use Thinkorswim? Other platforms are going to be different, but with Thinkorswim, what you want to do is go to your monitor tab, and on any position, so like if I wanted to roll my leaps out into the future, which The only reason I rolled this now is because I made a mistake. I should have had further out expirations to begin with. But if you wanted to roll one out, push the expiration out a little bit, you're going to be paying some money in extrinsic value, but maybe you just decide, well, there's 30 to 45 days left. I still want to keep this call option open on the stock, but the decay of extrinsic value is starting to ramp up exponentially as it does within 30 to 45 days. So theta's ramping up. I want to push my call option out further in expiration so theta is not such a big factor, not a large percentage of the value of the option. Well, then you can right-click your call option. You can create a rolling order and hit buy calendar, because you're basically buying a calendar even though you already have an option open. So here you can see we're selling the option we already own, and then we're buying to open a new option, and we can change the expiration date and the strike and the limit price and all that jazz. Okay, and that'll come into play when we roll our put option for the wheel strategy as well. Okay, another thing people have been asking me is like, Adam, why don't you run the poor man's covered call? Why aren't you selling calls against your leaps? The reason for this is, well, I definitely would be, but I changed my net income on TD Ameritrade, the website, when applying for an upgrade on this account for options trading. And they said, since I changed my income value, I cannot apply for an upgrade for another 60 days. So I'm stuck with my hands tied. I can't trade the poor man's covered call. Okay, although I definitely would. Also, something with Bumble. Bumble has earnings coming up. That little question mark right there, that is earnings on 5/10/21. Is this good or bad for us? It's like kind of a mixture of the two. It could be really good. It could be kind of bad too. But here's why. As a lot of you know, as you lead up to earnings, implied volatility rises. Even if we look at this implied volatility chart down here, it's decreasing, but there is a portion of this implied volatility given to this earnings announcement because people anticipate the earnings announcement is going to cause a move in the stock price, and that is volatility. So the demand for these options start increasing, so their premiums start inflating. That is an increase in implied volatility. And then right after earnings, after the binary event has taken place, things are good or things are bad, demand for options suddenly decreases, therefore implied volatility decreases, therefore options premiums deflate, specifically, extrinsic value deflates. And that's called IV crush. And that's good for us because as IV goes down, as implied volatility goes down for options that we net sell, we make money. So if I can sell now and hold it through earnings, and if the stock trades sideways, I'll still make money. By trading sideways, I mean the stock stays within the same relative range. I will still make money because implied volatility will collapse after earnings, and that's good for me because I'm the option seller. Remember, when you buy options, an increase in implied volatility is good because it inflates premiums. I don't want premiums to inflate as an option seller. I want them to go down. I want options values to decrease so I can buy to close at a cheaper price or just hope that they expire worthless at some point. But particularly when extrinsic value decreases because of IV crush, I'm looking to buy to close at a cheaper price. Right? Because I know at expiration that extrinsic value is going to decay anyway, regardless of how thick or thin it is. So that's good, right? It's good that IV is going to go down because that's good for a short options position. But what's not so good is it also means, there is going to be some volatility. So it could really push my option deep in the money. So if earnings comes up on May 10th and things really drop for whatever reason, bad outlook, whatever, earnings not so hot, well, then I'll probably definitely roll as soon as possible. A cool tool that TD Ameritrade has is if I go to the Analyze tab, see this MMM, that stands for Market Maker Move. This is an implied move extracted from the inflation and extrinsic value. So what it's basically saying is all these options traders are buying up these options. There's an increase in demand for these options because of earnings. How much volatility does this increase in demand imply? People want these options a certain amount more because there's a certain expected move in the stock on earnings. Well, you can actually extract that expected move from the inflation and options premium and give you an idea of what options traders think the stock will move on earnings. And that's exactly what this market maker move is. It says plus or minus 4.9, so about plus or minus 5 points. So if I go to Bumble, what that means, if I draw my trend line here, it means it's going to go up 5 points or down 5 points. I can't go quite that far. Okay, about 7% to the upside, 8 or 9% to the downside. So we have an idea of what people think will happen on earnings. Statistically, this represents about a 68% chance that the stock will go up or down 5 points and not outside that range. Of course, this is just implied by options demand, so what will happen in reality could vary quite a bit from what is shown by the market maker move, but it gives you at least some idea of what people are thinking. So if things go up on earnings, that's great. If it goes up by 5 points, that's going to be great for my cash secured put. And as it goes up 5 points, implied volatility is also going to come down because of that IV crush we talked about, which really influences options that expire shortly after earnings, which is my option. So I'm going to make money as the stock price goes up and as implied volatility goes down. Or if the stock price goes down, implied volatility is also going to go down, so it's going to hedge some of these losses. Okay, so selling options around earnings is, it kind of sucks because sometimes when it really moves and it gets you assigned at not the best price ever, but a lot of times it doesn't move as much as people think, and IV crush happens and you make some quick money overnight, and I could buy to close and sell to open a new put option that's maybe higher in strike for more premium, whatever. Okay, so right now, what are we doing? We're doing nothing. We're holding on to our butts. That probably looks like I'm holding on to my crotch, actually, but I'm holding on to my butt. And yes, I'm down, $500 year to date. And if things keep going down, I will just buy more leaps. Obviously, that doesn't work for everybody, okay? Because leaps for some people, maybe you, are higher risk than for me. Because I have plenty of money set aside so that I can easily deposit more funds to buy more leaps if things go down. And that's the important thing with leaps. That's how you increase the probability of success dramatically, is by averaging down or at least buying another leaps when the stock price drops, making your current leaps like borderline worthless. If you can't buy another leaps when the stock price plummets really, really hard and like basically just destroys your call option, then you should at least buy some shares of that stock. So as things rise, it'll recoup some of the losses of the leaps. Okay, I'm gonna stop saying leaps because it sounds plural. I'm gonna say leap. Okay, I know it's not really right because it's supposed to be long-term anticipation security, not long-term anticipation, but I can't because when I say leaps, it just sounds like I'm saying it plural. It's breaking my brain, okay? So if it goes down really hard and your leap dies hard and it's below your strike and you don't know what to do, you don't have the money to buy another leap, well, what you can do is buy some shares, okay? At least when you buy shares of a company that is going to be successful for the long run, even if it goes down over the next 8 months and your leap dies and then you buy more shares, but the company's still a good company, it's going to increase in value over the long term. So you'll recoup the losses or at least some of the losses of your leap option. If you can't buy another leap option when the stock price dies, that is riskier. You're trading leaps, that it's going to be a little bit more risky for you because if things go down really hard, you're going to lose quite a bit of money and it's going to take a while for just a handful of shares to recoup those losses. Okay, it'd be way quicker if you just buy another leap and then the stock goes up. It's going to recoup your losses quite quickly, but it's better than nothing, okay? It's okay to take it. This is better risk than FDs, let me tell you. Okay, ridiculously low break even, ridiculous time horizon. You're putting all the probabilities in your favor, except for when things go really, really against you, and that's when you have to be buying the stock or buying more leaps. But we'll touch on that when we come to that, if that ever happens. It can totally be possible that the stock market just keeps ripping upwards, and all I'm doing is just buying more leaps because I want to keep leveraging to the upside, not because I'm trying to average down, although this isn't really averaging down, but just buying more positions to recoup any losses. So it's totally possible that every single leap I have here, the AMD Activision, I bought a second Activision leap, by the way, because they are a cash cow. I mean, you can just eyeball these fundamentals, and it's just crazy. They're making so much money, especially because of coronavirus. Well, it's entirely possible that all these options make money, and I never have to buy a new one to recoup any losses ever. And that's entirely likely with such a low break even and far out expiration. But of course, if things do go against me, it requires that I fork up more capital to recoup losses and not pussy out. Also, Doge, huh? I was thinking about Doge, and I was thinking why do people want to buy this so bad? There's no value really in Doge. Where's the value in Doge? I don't get it. It's very arbitrary. And then I was like, wait a second, isn't that what the dollar is? Isn't that we just give value to the dollar? Is the dollar Doge? Can Doge be the new dollar? It's just attributed value. Screw it. Doge, the new global currency. All right, thanks for watching, guys. Remember all the things in the description below. Okay, that's the stuff that, this stuff makes me money. That stuff makes me a lot of money. So if you learned something, go check out the free stocks. All right, win-win situation there. Love you. Catch you later.